Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is Jeremy Roll. Thanks for being on the show, Jeremy.
Whitney, really happy to be here. Thanks for having me on. I really appreciate it.
I'm honored to have Jeremy on the show. I think most people in the industry know Jeremy as an expert in this field and in his line of expertise, which most have heard him on the show before, on show WS 155. And if you didn't get to hear that, I would encourage you to go back and listen to that as well. But Jeremy started investing in real estate and businesses in 2002 and left the corporate world in 2007 to become a full-time passive cash flow investor. He is currently an investor in more than 70 opportunities across more than $1 billion worth of real estate and business assets. Wow. As founder and president of the Roll Investment Group, Jeremy manages a group of over 1,000 investors who seek passive, managed cash flowing investments in real estate and businesses. He is also the co-founder of For Investors by Investors, also known as LIFEBRIDGE, a nonprofit organization that was launched in 2007 with the goal of facilitating networking and learning among real estate investors in a strict no sales pitch environment. LIFEBRIDGE is now the largest group of public real estate investors meeting in California with over 27,000 members. Jeremy, thank you again so much. Why don't you give the listeners an update about what your focus is now, or any deals, or what's happened recently, and then let's dive into this topic of this due diligence from a passive investor standpoint.
Sure. So again, thanks for having me on. Really appreciate it. I have essentially, since I saw you last, been mostly sitting on the sidelines looking for what I call like unique deals, either unique pricing or some unique aspect to it. I am, for anyone who knows me out there, they would agree I'm ultra conservative. And so I've been mostly on the sidelines, plus or minus, since early 2017, kind of waiting things out, hoping for an eventual adjustment or change in the market. I do believe we're going to have an economic downturn coming up here. And I am mostly waiting on the sidelines, kind of being more of a happier seller than buyer, so to speak. Still making investments, but they're really, really hard to find. And so my volume is definitely much slower, which when you're a cash flow investor is just not fun. So it's been a very long period of about 2.5 years now that I've been mostly on the sidelines. I had the exact same experience from 2005 and 2008. It was a very long, just grueling 3 years. And I'm in the middle of going through that right now. So I'm very much looking forward to some type of market adjustment and still looking for stuff in the meantime.
Nice. Now, and I'm hoping we can get into some of that either in this show or in another show. But today, we really wanted to focus on just the due diligence that a passive investor needs to know to do, right? And I'm just looking forward to getting into this topic with you. But get us started, and what needs to happen, and and helping us to know what that passive investor needs to know when he's contemplating investing in one of these deals.
Sure. God, there's so many things I can pass along. First thing that comes to mind immediately is, and I really strongly believe this, who you're making a bet on is more important than the property itself that you might be considering. Now, the property is ultra important. I'm not going to make it sound like the property is not important, the location, the profile, etc. But who you're making a bet on is even more important. And I would actually say the same thing when you're investing in startups, for example. Don't get in love with the deal, you get in love with the team and the founders, and then make sure you like the idea well enough, because things can happen and sometimes things need to be fixed, changed. Strategies can change depending on market conditions, and you want to have the right team managing everything. Now, when you're investing passively in real estate, for example, you're giving up control. I'm just generalizing, but in most cases, you're a small piece of a big deal. Even if you have voting rights, which usually you do, it'll be a very small percentage. It's almost not meaningful on your own. And because of that, you are giving up control to somebody else. And that is why it's absolutely key who you're making a bet on, both in terms of experience, knowledge in that asset class, and perhaps even that specific geography. But also, very importantly, is, are they someone you can trust? That is very difficult to surmise. There's a lot of things you could do to try to paint the picture as best as possible. And keep in mind, too, that when you're a passive investor, unfortunately, you can't get rid of all the risks. I like to call, there's 20 different what I call 1% risks that anybody can face at any time in a passive investment that can't be eliminated completely. One way you can get around that, aside from doing your due diligence and figuring out who you're making a bet on, and then obviously looking into the property, is diversifying. And so I'm a huge fan of diversification. I'm hyper diversify, which is why I'm in so many different opportunities. But diversification can save you even if you make a bet on the wrong person, within reason. In other words, don't put all your eggs in one basket. It's funny. I literally just spoke to my 11-year-old son explaining diversification like a week ago. And I was telling him, look, you got an egg, are you going to put them all in one basket? You're going to have 10 baskets with 10 eggs. And if one basket tips over and the egg breaks, you've got the other 9 left. Very simple. Everyone listening to this probably understands that, but not everybody always invests like that. And I think it's really, really critical too. So first thing that comes to mind for sure is, who you're making a bet on is the number one thing, followed by the property. I don't know if you agree with that and if that makes sense to you.
It does completely, without a doubt. The operators, the first importance, and then obviously, like you said, the property is extremely important, but after the operator. But let's dive into that a little bit. Who you're making that bet on, that person or that operator. Can you elaborate on what you like to see there, or how you investigate that?
Sure. So a few things that I do that may be helpful here. So first of all, I always do background checks on all the managers in the all the managing members of the manager entity. And that involves asking for personal information. So I personally always ask for name, home address, and date of birth. That's very sensitive information. If someone is hesitant to give it to me, I could kind of understand that. But at the end of the day, if they're not willing to share it with me and I can't run the background check on them, that's a red flag, meaning I can't move forward. But background checks are critical. I just seen a lot of instances where, when something has gone wrong, in most cases, I ask the person, did you run a background check? And honestly, I cannot remember the last time that somebody got into a bad situation with like the wrong person and told me, yes, I ran the background check. Now, the background check will not save you all the time because somebody could be, kind of have like the right mindset and then could become a Ponzi scheme in the future after you invest and nothing's going to come up. But please run a background check before you invest in people and run them on everybody just to be sure. So that's a very, very important step.
Do you have a website or some way that you do that background check that
so
resource that we could use?
I use kind of like a very high level, very professional. I use a service that basically the police uses also. So, and you can get access to it, but you have to be a bona fide business. You have to have a real office location. They require you to have like a locked door with a key that goes into the door in the room. Like there's very specific things. You have to have a cabinet that's locked, and they come check all these things in person before they approve you. But that service is called TLO, like Tom, Larry, Officer, and TLO.com. It's actually owned by TransUnion. There's another one owned by LexisNexis called Accurint, which is ACCURINT.com. Those are what I would call like the two best known. There's recurring fees. I believe that it costs me a minimum of $50 a month, even if I don't use the service at all, just to give you an idea. So it's expensive, but definitely very worthwhile, and you get more information than you really ever need, in that type of a check. You do not get a credit check, but you get everything else. So I recommend either of those based on what I've heard and my own experience. If you cannot get access to these, there are some online sites from what I've heard. And what they're essentially doing is normally running checks with similar databases. You can either hire a private investigator who will actually run a check in one of these databases I mentioned, and then you'll pay them to like actually run it for you and then interpret it for you. I have used, before I got access to these databases, I used private investigators. They're not cheap, but they can be really helpful because they can interpret things. And they have years of interpreting these reports, and the reports are not 100% obvious.
So help us with that report a little bit. Okay, or let's back up a little bit before we get to that report. When are you asking for that, or for this information from the operator? Is it going to be pretty early on? Obviously, I'm going to need to feel like, I don't know, that we've got some relationship going here before I just hand you this information as an operator.
Yeah. So what I do is I'll get the offering documents first. I will review them to make sure that it looks like it's a fit for me from a numerical perspective, right? Am I okay with the cap rate, the purchase price, the price per unit, the location, the business plan, the general strategy, the occupancy rates? Is it even the right profile for me? Because I have a very specific profile that I target, right? Are the cash flow minimums hit or not in the projections? If everything checks off enough boxes, then I will then ask for the background check information. But I will dive into the deal first before I go there, because I don't want to bother anybody for sensitive information unless it's really possibly going to be a fit for me.
Great. Great. Okay. So then, help us a little bit with that report. What are you looking for on the report? What's going to be a big red flag, or maybe some things that you might see on there that's not a big deal?
Yeah, sure. So it's interesting because this is a very subjective topic, and I'll give you an example. If somebody has 10 speeding tickets over the last 4 years, are you okay with that or not? Most people, maybe. Some people, maybe not, right? You're going to see that information. Now, if somebody has any judgments against them or any liens, if they have a whole number of people suing them at once. So I'll give you an example. I actually once was saved somebody who was looked to be fraudulent, who basically had previously lived in a state, had 40 people or so sue him, and then he moved to another state, and then he saw the same pattern again. Now he was in his third state when I met him, right? And so you can argue, look, if the person maybe actually wouldn't be found guilty in any of these cases, but to me, it's not worth taking the risk as a personal opinion on someone who so many people has pursued, even if maybe they're all wrong, because it's just not worth it. You can go on to the next, right? So that would be something I look for sure, certain lawsuits. Sometimes people have tax liens, and once in a while, a tax lien from 4 years ago, they didn't get it in the mail. They didn't pay the bill. They got the lien, and then they paid it off within a year. That's okay to me. It's a relatively small amount. But what if they have tax liens from like 2004 that have been, renewed every 7 years, I think it is. I forget the exact number. And they have more than one, and these are large numbers. And, what is that telling you? Well, you have two choices. You can either just move on to the next, or you can ask some questions. And I often do ask questions because you'd be surprised. Sometimes there's actually a really good, reason for it. I remember once there was a large tax lien, and I said, well, what's the deal with that? Well, I got divorced. My wife isn't agreeing to pay their half. So I'm not paying my half. And we're currently pursuing, I'm pursuing her to get the half, but it's been sitting there for years. That's a pretty good explanation. It sounds reasonable, right?
Right.
I remember once I had someone who got firearm possession, illegal firearm possession. And what happened is that it was 15 years ago, and somebody had a gun in their trunk, and they actually forgot that they had it in their trunk. They were transporting it, and they got stopped, and the police officer found it. And it was a licensed gun. It was theirs. It was completely, legitimate, but they weren't allowed to transport it the way they were transporting it in the trunk. So is that okay? Probably. People are allowed to own guns if they're licensed. So there's a lot of subjectivity to this. I personally have the philosophy in general that there's a lot of opportunities out there. And so it doesn't take very many yellow or red flags for me to just move on to the next, because if I could take a similar risk on someone else who doesn't have those yellow and red flags with a similar return, that to me is a better situation from the start. So that's how I handle that type of situation.
Okay. So you're going to learn a lot of information about that person, maybe even things they've forgotten about, years ago.
You wouldn't believe, there are definitely times I found where somebody assumed, let's say a bankruptcy that was 7 years ago, they assume it's wiped because it's 9 years ago, but it's not wiped on the report. It's only wiped from a credit report standpoint, and they don't share it with you. The one thing I do, which I would recommend, is before I run a check, I say, look, I'm about to run a background check on you. Is there anything I should know before I run the check? And I got that explanation about the firearm thing because I asked the person in advance. So before I saw it. So I like giving that opportunity so that they have that chance to pre-explain something instead of trying to hide it. Because I actually, just 2 weeks ago, somebody emailed me and said, I just found this on the check. I asked them in advance about it. They didn't say anything. I was like, you know what? That is just too obvious and too big of a flag. I think they probably hoped it was a long time ago and they didn't mention it. It's too much for them to forget to tell you. And so we agreed they were just going to move on because of that. So that's another good strategy I definitely recommend.
That's some good investigative work there, Jeremy. I used to do that as a police officer as well. I would ask that same question, ask people ahead of time. But anyway,
you give us some tips then. What tips do you have?
No, that's interesting. But asking them ahead of time, giving them the opportunity to come forward with that, it's good too. Just seeing if they're going to be honest. Like you said, it's just giving you more information. What should I know? A lot of times, as a police officer, you may not even actually going to be run the check or to do that thing, or you may not be able to, but they don't know it. So there's all kinds of ways. You're pulling bluff. Many times just to try to save your neck. On the side of the road somewhere.
But this brings up an important topic that I want to make sure we cover today. Which I'm sorry, I'm switching topics a little bit on you, but. One of the things that I try to do when I'm doing my due diligence and I'm trying to assess character is a lot of the questions I ask, I care less about the answer than how it's answered, which I'm sure you'll appreciate having been a former police officer. So give you a good example. if the vacancy rate in an apartment building is truly 2% today, but it's showing a 10% vacancy rate in the pro forma, then I ask, well, why is there such a big spread? And what I'm hoping to hear is, well, we're really conservative, even though we think it's going to be 3% ongoing. Realistically, we're putting in the padding because we want to make sure that we set the right expectations, hopefully under promise, over deliver for investors. That's like the optimal answer to me. And so but I asked to hear the answer to make sure it isn't something else that just isn't what I'm expecting. On the flip side, if somebody has a building that's 15% vacant today and they're assuming it's going to be 3% vacant for the next 10 years and make the numbers look really good, and they're really aggressive assumptions, I don't want to hear, well, the submarket has had a 2% vacancy, so we think 3% is very conservative going out for the next 10 years. Like, who knows what's going to be happening 8 years in that submarket? That's just not that conservative. So and by the way, I kind of already have an inkling as to why that is, but I'm asking just to confirm and just to hear their philosophy. And a lot of the times what you're trying to do is read between the lines to understand their philosophy, so you understand who you're making a bet on. Another great example is I see that you assumed 4% rent increases for the next 10 years on average, but 2% expense increases, right, for the next 10 years. And they may respond, well, this market's been growing at 10% in the last 2 years, so we're using 4%. That's going to keep going on for the next 10 years. Someone else may only assume there's going to be a 4% increase for 2 years and then leave it back at 2 or 3% for the next 8 years. That to me is somewhat much more conservative. And sometimes you see it and sometimes you don't. It's important to ask the questions. And again, sometimes it's just more about how they answer and understanding their philosophy as opposed to what the actual answer is. That's very important.
Well, they're going to expose their plan, right? By how they answer the question and how they've thought through their assumptions.
Yeah, and I would say that one of the basic end goals I have is I'm trying to make them bet on somebody who is looking to under promise and over deliver to investors and not be aggressive and just be a conservative person in all the expectations I set, which will hopefully trickle down into everything I've read and all the projections and everything as a general philosophy, as opposed to someone who's being aggressive, trying to make the numbers look really good to attract investors because the returns look good. And then we'll not really concerned about building long-term relationships with investors, but want to just get the deal closed. And then they'll just move on to another investor next time if they have to. And so high level, if I could summarize it, that's what I'm trying to find as far as an operator philosophy.
Okay. So we got the background check, and now we're going into some of the questions that you're asking, but you're more concerned really with how they're answering those questions. But either we move on or give us some more questions that maybe you ask, that
sure, yeah, just to be clear,
you should know.
Sure, just to be clear, it's not 100% of my questions are not geared towards how they're answering. Some of them I'll ask that. And in some of the cases I want to hear the answer, but reading between the lines is more important than the answer sometimes. Questions. I literally just looked at an opportunity 2-3 months ago. It was an ATM, not real estate, it was ATMs. I've been investing in ATMs 11 and a half years. And I remember I actually had over 200 questions. So there's a lot of questions you can ask. If we just take, I like using apartments a lot. I think a lot of the listeners understand apartments and may have lived in apartments, so they can relate. So, you may want to understand all their inflation assumptions on the revenue side, the expense side, and ask questions about that. I personally go line by line, asking questions about every single item. So, you may want to look at the entire expense ratio, and in apartments, that's very important. That'll be dictated potentially on what's reasonable based on the type of building, how old it is, the type of utilities that have to be covered in the common areas, and even the climate, right? So if you're in northern New England and you have to pay for the common areas to be heated, the expense ratio in the building may be more expensive than a building in Florida. I'm just making that up. But you want to ask, why is the expense ratio this big or this high or not this high? Or I normally see it in this range for apartments. Why are you below or under those? That's very important to understand because that feeds into the assumptions and the projections for profitability, for example. But I would go line by line, all the revenues, all the expense items, see what flags up, ask questions about those. I would ask questions about how they assume the exit price, the cap rate that they assume at the end, the multiple they're going to get for the property, how they come up with that. You definitely want to dig into the comps, the rent comps, and even the sale comps to justify what price they're paying right now, as well as what rents they're assuming they're going to get, and even the occupancy rates in the area. So that's very important. I love asking about, and these are all just examples, but I love asking about how somebody determined that the area was a good fit. So in other words, are they thinking about population growth for the next 10 years? Are they thinking about economic growth for the next 10 years? And how do they get all of that information in that submarket? And so one thing I'll often do is ask for that data. And so when they send it to me, you can get a good idea of how thorough someone is. This is a great example of like the answer, is important, but if you read between the lines, if they're very thorough, you're going to get a lot of data. If they're not very thorough, you're going to get a piece of data, right? And that tells you potentially what they're like and who you're dealing with and who you're making a bet on as a philosophy. And I actually sometimes will maybe not necessarily take their data for granted, but then maybe even do my own research on the side just to validate that it looks right. And this sounds very rudimentary, but I often use Wikipedia because they actually source different sources. They link to different sources, where I might look at the census data off of Wikipedia because it's very easy at a glance, and compare it to whatever data they're using and see if it actually lines up or not, just to make sure they're using sources that seem like they're actually correct.
Any other sources that you use that would stand out that where we could go find this data also to double check?
God, I'm trying to think.
Like city data.
What's that?
Like citydata.com.
Yeah, city data came to me right away as one of the ones automatically. But I like to take it's interesting. As a philosophy, as an investor, I like to say that you want to trust but verify. And so if you have a very experienced operator, you want to trust they've done their research but verify. And so the approach that I take is I'll get them to send me their data, and I'll try to validate that what they did was thorough enough and it looks right. And so sometimes they'll send me city data, but then I won't go to city data clearly. I'll actually go to another source. But I'll usually start with Wikipedia. I usually start off trying to verify it with the census information to look if that even starts to look somewhat correct. There's a lot of actually good sources you can use. City data is probably one of the most popular ones, I would say, out there. But again, it's about, I don't think an investor should have to research everything from scratch, because it's really the operator's job to determine if that even makes sense to acquire. And they're the ones who have to have done all that research, but you have to verify they've done the research, if that makes sense.
Yeah, hopefully we've already done the research before we've chosen that market.
Yes. But, it varies. I mean, it just personalities, different levels of thoroughness. I've seen things over the years. So it's something you really have to verify.
All right. So now we know a few more questions. We know a few more things that we should be asking about it. Even if you don't know specific questions, you can look at the underwriting, like you said, and go line by line and probably get, it's going to stem more questions for you just hearing the operator talk about a few things that you ask about. Right. Yeah.
I really strongly recommend you go line by line. A lot of people don't get into that level of detail, but I see different ways people approach expenses. So for example, do you want someone who just assumed 3% inflation across every single expense item? That's not necessarily unreasonable, but what's interesting to see sometimes is like healthcare, a cost for employees, let's say for self-storage as actual employees. And that might go up a different rate. They may say, look, I'm actually increasing healthcare 5% or 7% based on what's happened in the last 2 years each year. It's not just a 3% item, because it's not going to be accurate by the time it's done. And by the way, as an investor, if it's kind of like lowballed, so to speak, then by the time year 10 comes around, your net operating income looks better than it probably is going to be. So that's not really conservative, right? So you really, if you are able to, I'd strongly recommend you go line by line and really start to question everything and make sure everything really looks right to you.
Okay, so now you've been through the underwriting, you've done the background check, you feel like this is a pretty good deal as far as what you've seen there, that data, and you verified it. What's next, Jeremy?
Next step would be, it's up to you in terms of spending money, but what comes to mind, several things come to mind: background check, operating agreement, and private placement memorandum. But operating agreement, that's very important. We can get into that. On-site visit, which I know a lot of people don't necessarily have the time to do necessarily, but it's one of my key roles. And certainly, if you've never invested with an operator before, I strongly recommend meeting them in person at least once before you invest with them as part of this gut check. Because we talk about philosophy and everything on this podcast, but in the end of the day, you take everything together and it's a last check at the gut check, right? But it's really your mind putting everything together. And one of the pieces that I think is very important is meeting someone in person and being able to continue to assess them, which as a former police officer, you probably would agree with that. Meeting someone in person versus the phone, it's different.
It is very different. Body language tells you a lot.
And when you get a property tour, you can really start again to read between the lines and see how thorough someone was in actually understanding the competitive landscape within the area. Some people will just go right to the property, give you that, and then if you ask them for like an area tour, it'll be lackluster. Some people will go off on an area tour for an hour and tell you every piece of every corner because they really investigated that exact location very carefully, telling you again, just about the person's personality. But I want to go back. Can I go back to the operating agreement?
Yes, please.
I'm sorry I'm jumping around for us, but these are all very important points. So operating agreement, for those of you not familiar with what an operating agreement is, it typically is used for an LLC, which is the most common entity that you'd be investing in as a passive investor. And it dictates the rules. Okay, so the rules that have to be followed by the operator for the company that you're investing in, all right, which is then acquiring the property. Absolutely critical. And I cannot stress enough to read this. It's a legal document. I'm not an attorney. A lot of people find it boring to read and don't want to read through 30 or 40 or 50 pages of an operating agreement, but it is critical because you need to know what the rules are before you agree that you actually should invest in them, right? So is the operator required to send you a report every quarter, or how often they're saying they're going to? And by the way, is there a deadline as to when they need to send it to you by each quarter? Are distributions even required to be made by the operator per the legal document that you're actually investing in, the rules? Cash call provisions. Are you forced to put cash in? And if you don't, are you getting diluted? Or what are the provisions and how do they work and what are the steps? Because those are all outlined in there. They should be. And actually, if they're not, and if none of this stuff is outlined in it, that's another flag, right? Because that means that that hasn't been pre-thought out. There are no rules. So it's critical that you read, and there's a lot more we can discuss, but it's critical you read that document and make sure that you're okay with the rules before you invest. And unfortunately, I do believe that a lot of investors don't read them, but I think they're absolutely critical.
I think what would be good, because since we don't have a whole lot of time left, I think let's talk about the operating agreement more, because there's a couple things I'd like to get into, and then we'll do a second show to finish some of this, like the on-site visit and meeting in person and some of that.
Sure.
And so, but I'd love to go back and let's dig into some of those specific things, like you mentioned, distributions and getting diluted, things like that may be foreign words to some of us that are listening.
Yeah. So, well, let me start with getting diluted. So cash call provision is actually the rules that dictate what happens if the operator needs to ask for more cash from the investors or just needs more cash to operate. So besides the reserves that hopefully they will have held, if they run out of the reserves and need more cash to be able to operate the property, what happens? And so everyone has a different philosophy as an operator as to how to handle a cash call provision, and that's okay. It's very subjective. I personally have a certain way that I like for it to be handled optimally, but that's just one person's opinion, which I can share. But the bottom line is that I've seen stuff I remember there was one operating agreement I saw where the operator can ask for any amount they wanted at any time. And if you didn't put it in within 3 business days, you got diluted by 50%. Okay. It could have been, so they could have asked theoretically for $1 million from each investor because they wanted to. And then no investor puts it in, and now they're diluted 50%. They own 50% more of the project, and it's actually the rules, right?
Wow.
So I figure anybody who invested in that deal just didn't read the documents, because I've never seen anything like that before. But it was there, and it was a real estate opportunity. It's a syndication.
Wow.
So
written by an attorney.
Written by an attorney, or maybe edited by the operator before it got sent out. Who knows? So the cash call provision is very important because you need to know that once you put your cash in up front as an investor, that you're not necessarily legally obligated to put more money in up after you do. And what happens if you don't, right? So if there's a legitimate cash call that's required, then how's it handled? Do you get diluted because you don't put your pro rata share in? Is it a loan that's taken against the company first before they can dilute you? What steps do they have to go through? And what interest rate will that loan be at, et cetera, et cetera? It's important to understand these things, in terms of what you're getting into before you get into it. Distributions, those are obviously cash flow distributions or any distributions, made by the company. Is there even a requirement? Like the operator can say to you, we're planning on sending out quarterly distributions. And that's okay. That's their plan. But legally, what are they supposed to send to you? What do they have to send to you? And very often it will say in the operating agreement that the operator has to make quarterly distributions, for example. That's the most common. Of any available cash available for distributions. Now that's actually subjective. That's the operator gets to choose. Is there available cash, or they have to hold it back for reserves for some other need, which could be very legitimate. But you still want to look in there and make sure that they actually do have to make distributions, right? Because in some less detailed operating agreement, it won't even be in there at all. And then it's not in the rules. And then if you never get distributions, you can't go pursue that person because it's actually not a requirement in the legal document, for example. So you just have to get all the rules, understand them all, make sure you're actually in alignment with them. It's very important.
You mentioned earlier about, the reserve budget. If if they use all the reserves, now they may have a callback provision, things like that, or where they may call for more money. But what about what kind of reserve budget do you like to see?
It depends on the property type. I invest across all different asset classes, and also depends on the business plan. So if you buy a stabilized property and it's a 100-unit apartment building, it's stabilized, it's relatively, say it's built in the last 10 years, and so it's in good shape. There isn't that much deferred maintenance, and there was nothing found during due diligence that required a lot of deferred maintenance. The reserves can be a lower amount. If you're buying an older property, you're planning on rehabbing it all, well, you want more of a cushion in reserves in case maybe you go over budget. And then you're still going to have a cushion for later on to operate it. So that reserve level should be higher. So it's really going to depend on the type of property. And each property type has different reserve requirements.
Wow. All right. Anything else, Jeremy, as far as what we've already covered? I mean, there's numerous things that we could still go into, but unfortunately, we're about out of time.
Yeah, I'm sorry. Hopefully, I didn't ramble on too long. But
no, it's good. This is great information. Great information for the operators that are listening, and also the passive investors that are listening. But anything else, or maybe even about the operating agreement that we should be thinking about or know to look at? Because obviously, you get these documents, you get so many pages, and they're small type, small print, and most people are just going to go through and sign it and just assume that it's correct. But anything else? Obviously, you've mentioned there's some great things. Anything else that we need to be thinking about?
Well, just to end it off for now, I would say that I really cannot stress enough that you want to take enough time to understand who you're making a bet on, prioritize understanding who you're making a bet on ahead of the property and the numbers. I think a lot of people don't do that. They kind of get enamored by the deal. But you really want to understand how long someone's been operating, their philosophy, their track record, which, by the way, even a track record, in my opinion, isn't necessarily the greatest thing to look at. If somebody started investing in 2011 at a perfect timing, has sold off several properties since, the track record is going to look really good. And if it doesn't, there was a serious problem because they haven't been hit by cycle yet, right? So end of cycle. So, but you want to really do your best to read between the lines and evaluate who you're making a bet on. I'm sorry I'm being repetitive, but it's just so critical to make sure you're making a bet on the right person once you give them full control.
No, it's great information. We can't say it enough. So making sure we're hearing this. But just a few questions before we have to go. I might have to pivot just for a minute, and then we'll do another show. So listeners, I hope you'll come back tomorrow, and we'll finish talking about a few of these topics. But Jeremy, what's a way that you've recently improved your business that we could apply to ours? This is going to sound probably very rudimentary, but I just switched email providers. So I was with a hosted exchange server company that I've been with for a long time before the cloud even started. And I just switched to Microsoft Exchange 365. And their level of service has been fantastic. So if you're out there and you're wondering if you should switch to Microsoft, I'm not being paid to switch you to Microsoft or anything. It's not a paid ad, but the level of tech responsiveness and in my opinion, so far, it's been a couple weeks of what's the word I'm looking for? Knowledge of the reps and stuff. I've been blown away how good it is. They treat you almost like as a business level, and they know it's critical for businesses to keep functioning and stuff. So just been blown away how good Microsoft Exchange 365 has been so far. Nice. And what's the one thing that's contributed to your success?
One thing. That's a good question. I like to say that, and this has been not just for my, kind of investing career, but even before, persistence is just the willingness to grind it out, to kind of go to whatever extent is needed. Sometimes to an extreme that most people don't even think makes sense. I think that is just a huge, huge plus. Obviously you want to draw a line at the right place. But I tend to just really focus on persistence. I try to really teach that to my kids too. Nice.
And what about, how do you like to give back?
So I'm really lucky because I live off the cash flow at this point, and so it took a long time to get there, but now I love that I'm able to help people who are relatively new or even not new, just trade information, learn about passive investing, just help any way that I can. So I do calls with new people all the time, just have basic questions. I don't charge anybody. I won't do like 5 calls for an hour with somebody because I have limited time. but I'm always happy to help people any way that I can from just educating themselves in passive investing. And so I give a lot of time back every year on that, and hopefully it's helpful.
Nice. I'm sure it is. You've helped us a lot. Jeremy, you've been a great guest. I can't thank you enough for your time. Looking forward to us doing many other shows and diving into just your expertise here. But tell the listeners how they can get in touch with you and learn more about you.
Yeah, absolutely. Thanks for having me. And again, I'm sorry we've run over on this one. Hopefully you'll be able to continue to listen to the next one for this topic. The best way to reach me is definitely via email. So my email is jroll, JROLL, at Roll Investments, which is ROLL Investments with an S.com. So jroll at rollinvestments.com.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.